Good afternoon and welcome to Markets Today. I'm your host, Mbithe Muema. Now, today is the 17th day of September. It would have been an ordinary day if we had not woken up to news from Parliament with regards to His Excellency President Uhuru Kenyatta's rejection of the Finance Bill 2019. The cause for rejection is one. He says that the MPs need to actually go back and remove the element of the rate cap. And this is just one statement in the Banking Act that this is section 33. Just remove the whole element of the rate cap. There's no coercion, rather there's no explanation as to whether the removal will actually affect existing loans or futuristic loans. The conversation is there's a directive from His Excellency, the Executive Office, saying the removal of the rate cap is pertinent. Now, this has been a conversation long in coming. We have been waiting for it with a bated breath, but I certainly did not expect it to go this way. We'll be giving you an update of what has happened today, what has actually brought us to this point, and more importantly, what is happening to the Nairobi Securities Exchange. Formerly, I was an investment bank and I was trading equities. I'm very excited and I suddenly miss the old days because I wait to imagine the excitement that is on the trading desks today with regards to the Nairobi Securities Exchange, something that we have not seen in a while. What do we have what do we have for you with regards to updates today? We'll be looking at the rate cap decision. What does it mean for banking stocks? We'll also drill down and look at the earnings potential. So far, the banking stocks are about up already 5% over the day on the back of this news. We'll be giving you an update of what steps we expect Parliament to take in the next 2 weeks, what steps we actually expect analysts to take with regards to evaluating the banking stocks, and really, should you be buying more and how much further up can this banking stocks go? Other than that, there's not too much with regards to coverage of any corporate news. That's the key news that we are looking at. When we go for a break later on in the show, we will be joined by Mr. Kala Mugendi, who is an assistant head of investments at Citon. He looks specifically at the banking sector. He meets with the C-suite executives in the banking sector as well as invests on behalf of pension funds in Kenya. He will be giving us his view with regards to the banking sector and, more importantly, what should we be looking at in as far as the rate cap repeal conversation is concerned. Now, let's delve back into the rate cap conversation. Yesterday, His Excellency President Uhuru Kenyatta did send a directive to the Speaker of Parliament, rejecting the Finance 2019 bill and actually telling the MPs to remove the element of the rate cap. We have read this communique to the Speaker, and it's very direct. There's actually no room of really arguments or even debates. It's just straight. Remove this rate cap, then we can actually have the finance bill moving along. Now, the president is allowed by constitution to do this. Once he receives any bill, whether the finance bill or any other bill from Parliament, he has a certain time threshold within which to either accept or reject it or even revert it back to the main house. Now, this has been reverted back to the main house and it has been received, and the communique has been passed on to the members of Parliament. A couple of things are happening here. The next steps, we expect the MPs to make a decision as per the constitution within 14 days with regards to either accepting the reviews of the president and the finance bill going ahead without this particular element of the rate cap, or they would need to garner a 2/3 majority to reject the president's pronouncements. It looks like at this point in time, the rate cap could be something of the past. Now, another important thing that is happening today, Parliament is going on recess for 10 days. They will be taking a 10-day break up until the 29th. Now, we have seen the MPs come out and say that they will expect to make a decision on whether to go ahead with the president's pronouncements or to be able to fight back by garnering a 2/3 majority to reject what the president has said. Key dates you're looking out for is 1st of November to get a final view on how this decision comes along. Now, the thing is, when you're looking at the rate cap decision, a couple of things have happened over the last 1 week. Firstly, the MPs again sat in Parliament last week on Wednesday and reviewed the element of debt and removed the 50% cap with regards to the debt to GDP ratio, and instead put in law an element of a 9 trillion number with regards to the Kenyan debt. Today, the Kenyan debt is 5.9 and it could quickly ramp up to the element of 9 trillion. We have spoken to many people in parliament, in the private sector, the entire morning as we're trying to get our heads around this rate cap conversation. These are the key things that have come across. Fine, the government does need to be able to extend its borrowing to 9 trillion. They certainly are cost to that. But then there's a feeling that the local community, or rather the domestic borrowing element, might not be sufficient to be able to meet the 50-50 percentage split between local and foreign debt that has been envisaged in the past. In other words, there's a little likelihood in terms of moving ahead from 300 billion, which is what the government of Kenya typically borrows from the local economy. That said, the government is only left largely with the element of foreign lending to be able to come and get access to lending for infrastructure projects, and in a way be able to propel investments and government expenditure to spur economic growth in the medium term. That said, if you have a situation where a government has to largely rely on foreign debt for its funding of its infrastructure projects as well as its primary deficit at a government level, then you certainly have the element of the IMF and the World Bank and the global community looking at Kenya and looking at the extent of the refinancing risk. Now, anytime you talk about refinancing risk, when you talk about concessional loans, when you talk about our global partners, the key conversation that keeps coming up and has been on the table time and time again has been the conversation of the rate cap. So now that the rate cap is gone, it looks like the government will be able to more than adequately access global markets and access foreign credit. That leaves the local domestic market in a position where now the banks, without the rate cap, are freely able to actually be actually incentivized to lend to the private sector without having a situation where the government of Kenya is hoarding, not hoarding, but is actually taking on as much credit and pushing away the private sector. Now, a couple of considerations here. Is this good for us? What does it mean for non-performing loans? Can you be able to afford anything over and above 13%? Well, that's a conversation that we will be having later. What has happened on the NSE? Banking stocks are already up 5%. I tell you, it's a very, very exciting day. Do you know why? Equity Bank has traded 36.45 million shares. Now, this is a stock that typically trades anything between 2 to 3 million shares on a good day. When it stretches, you potentially see a trade of 5 million shares. 36.4 shares is almost 10 times over and above what we see trading on an average day. Who's selling? Foreigners are selling. There has been a foreign seller in the market, and they have taken opportunity of this positive news with regards to the rate cap repeal to be able to offload their particular holding in this counter. Now, we had a split between the foreigners and the locals buying these stocks. The banking sector is trading about 0.9 times with regards to its price to book valuation. That's certainly a discount, and we have been talking about a discount. We have been talking about a nimble industry and opportunities to actually buy this. In other words, the investment community had already gotten to the point where they're comfortable with no rate cap review, but then there was still value to be taken off the table for the banking sector. Now that this rate cap has been removed, it looks like the sky is the limit, one way or the other. Are there any considerations that you need to look out for? Who are the biggest beneficiaries? Certainly, we can see Equity Bank has or could be the biggest beneficiary because they have allocated the most with regards to government securities, and there's an opportunity for them to reallocate capital into the private sector, and they have always been out and adamant saying that the only time that they will be aggressive with regards to lending to the private sector is once the rate cap is removed. Does this actually hold? Will there be also more upside for the other banking stocks that we are looking at? KCB equity already up 5% on the day. A bit of a slow. We've not seen too much price movement on other counters such as Barclays and Cooperative, and these ones have always been attractive because of asset yields. Do we expect to see any more attraction to this particular counters, or will everything shift to KCB and Equity Bank? What should you consider? Is this a rally that is going to be sustainable, or could it be short-lived? In other words, what could the earnings of these banks, which have already come from a first half 19 reporting cycle with growth rates of about 5 to 6%, could we see this move from 5 to 6% to even double 10%, 15%, and in what time period? In other words, now that the banks are up 5%, could they be up 50%? Could they double, and when? Mr. Caleb Mugendi is an assistant head of investments at Citon. He covers the banking sector in his company and also allocates funds on behalf of the local pension industry into this particular stocks. He also engages on a day-to-day basis with the C-suite in the banking sector. We want to hear from him. What are his initial thoughts? And we also want to look at the fundamentals of the banking sector. So what happens to net interest margins? What happens to the cost of the non-performing loans, as well as the non-performing loan ratio and the cost of risk, and what happens to this particular industry? Who has the appropriate capital to be able to actually tap into this opportunity immediately? Who will be able to sustain their dividend? How will you be able to get a capital return as well as a dividend return? This is a conversation that we will be holding shortly. I hope you're excited as I am. I mean, 34.5 million shares traded in Equity Bank is certainly no small feat. What I need you to do, engage with us on our Twitter page, on our Facebook page, on our Instagram page. That is Metropole TV. What are you thinking? Are you excited about this? Are you skeptical about this? What are your thoughts? What is the government doing, and how should we be positioning for the way forward? Engage with us. We are actually running live on our Metropole page TV on Twitter. We take a short break on the daily commodities. Don't go anywhere. See you in a few.